Hello, everyone, and Happy New Year. Thank you for joining us for our income strategy update. So then let's start with a recap of 2024, a year where central banks embarked in cutting cycles and interest rates were quite volatile. Credit spreads did well, and equities markets also continued to rally. Can you give us your view of what were the key takeaways of 2024?
Sure. So I think 2024 was an example where the higher yields, going into the year, helped provide cushion from rate volatility and the sell-off that we witnessed towards the end of 2024. I think that's an important reminder for end investors. When yields are high, there's inherent cushion within the fixed income markets. So although we had a decent amount of volatility within the bond markets and even a sell-off after the Trump election outcome, we were able to still generate attractive, overall returns for end investors. But I think the key point going into the new year is that there's great value within the fixed income markets. And similar to my point about 2024, when you have attractive yields, there's this inherent cushion. I think investors have to remember that you don't have to get every zig or zag right in the market. We don't need central banks cutting rates aggressively to be able to achieve attractive returns within the fixed income markets, especially when you take into account a global opportunity set.
So let's dive into what to do within the bond market. Of course, our income strategy, global multi-sector, is perhaps our go-to strategy for what PIMCO is doing across the entire bond markets. Let's think big picture first. As we think about bond strategies, our interest rate exposure, our overall credit risk exposure. So big picture, how are you thinking about both?
Yeah, start as top down as you can get. And reinforce this very important point. Yields are attractive. Credit spreads are tight from a historical perspective. Equity valuations appear stretched. There's a lot of optimism regarding the economy. Even PIMCO believes that the U.S. will likely grow at 2% or so, perhaps even a little bit more over the course of the next 12 months. But the challenge for investors is a lot of that optimism is embedded in market pricing. So we think this is a time where investors should be reducing credit exposure, reducing some sensitivity to the economy, sensitivity to equity valuations, and come up with a creative way to generate yield in the higher quality areas of the marketplace. So as you've seen credit spreads tighten, as you've seen optimism or growth optimism build over the course of the last several months, we have incrementally brought down some of our lower quality credit risk, more economically sensitive credit risk. We've begun to further leverage that global opportunity set. So we do think going up in quality makes sense, not hunkering down in the lowest yielding, highest quality segments of the market, but looking to diversify into areas that will be resilient if we do have some type of unanticipated growth shock or the need for central banks to tighten policy far more than currently is envisioned by markets. So it hasn't been a radical shift in asset allocation. It's just been that classic steady shift into higher quality areas of the market as spreads have tightened, as equity valuations for the most part have continued to go higher. That's theme number one. The second relates to the fact that yields are quite attractive, but there's plenty of near-term uncertainty, particularly policy uncertainty from Trump. We have also steadily taken our interest rate exposure higher as well. We're not yet at the point we were at back in that, the beginning of the fourth quarter 2023, when there was a lot of pessimism, tied to, both the trajectory of policy as well as, the broad direction of longer maturity yields. But we have used this sell-off to steadily increase our overall interest rate exposure in the portfolio. We're still defensive versus passive alternatives. So we're not, quite at it, the type of interest rate exposure you'd see in the Barclays Aggregate Index, but we're heading in that direction, and we have a lot more room to add interest rate sensitivity to the portfolio to the extent that this sell-off continues. So again, fine-tuning of the portfolio, shifts in asset allocation, and then really leveraging the overall global opportunity set.